So I do think silver could play catch up substantially and get well over the previous two all-time highs of around $50 an ounce into the $70, $75 an ounce.
Welcome back to Metals and Miners. I'm your host, Gary Bohm, and today we're diving into the dynamic world of precious metals, market trends, and the strategies that are shaping wealth preservation in today's extremely volatile economic landscape. I'm thrilled to introduce Dana Samuelson, president of American Gold Exchange, whose expertise in gold, silver, and rare coins has made him a trusted authority in the precious metals industry. With decades of experience navigating market cycles and guiding investors, Dana brings unparalleled insight into the role of metals in wealth protection and portfolio diversification. I'm looking forward to exploring what's next for gold, silver, and the markets. Dana, it's a privilege to have you back on Metals and Miners. Welcome to the show.
Thanks, Gary. It's great to be here with you. Thanks for having me back.
Of course. All right, so Dana, let's begin with the stock market. The U.S. stock market has never been this large. Total U.S. equity market capitalization just hit a record almost $64 trillion, according to Goldman Sachs. That's double the size it was just 5 years ago during the pandemic. By comparison, from 2012 to 2020, it took that 8-year period to double in size last time it doubled. So now it's doubling much quicker. The U.S. stock market is now more than 3 times larger than Europe's stock market, and it's larger than the combined market size of Europe, China, Hong Kong, Japan, and India. Incredible. Do you expect this historic U.S. stock market growth to continue or for some reversion to happen?
Well, we're at extremely high PE ratios, 22 to 1, I believe, which are very high, profits to earnings. So that is a bit of a warning sign that we could be toppy. If it's a $60 trillion market cap, that's double our GDP. And if you said it's doubled twice since when?
2012.
2012. Well, our debt has doubled twice since 2006 or 2005. So I'm not surprised that it's gone up with our debt. I saw an extremely valuable interview with Michael Green of Simplify Assets about a year ago. And his thesis is that there's not value investing in stocks these days. It's momentum investing, and it's crowd following with so many funds. And he thinks that the stock markets today have a complete herd mentality. And when we get corrections that we normally would get, the steam doesn't get let out of the equation, which leads to bigger, more violent corrections when the corrections come. Now, we saw one of those in April when we had the tariff turmoil. So I am wary of stocks right now because I think the U.S. economy is rolling over. It's weakening. Now, it's not plunging into a recession, but I think we're eroding into recessionary trends. And I'm watching employment closely. So I would be wary of the stock market being toppy right now as a whole. And I think that when we get a correction, it could be pretty sharp. Now, I don't invest in traditional stocks myself, so I may not be the most qualified, but these are my general observations. And I do watch the macro around these events a lot.
Appreciate that. I'm going to ask you a question about the consumer as it relates to the economy here in a little while, but I want to ask you about the miners. The HUI mining index has underperformed gold for the past 20 years. Most of this time, the miners, they've struggled to make profits. That changed about 14 months ago. After gold broke out over $2,000, they've started being very, very profitable. In your analysis, are investors beginning to notice the huge profits that the miners are making? And what are you expecting for the miners moving forward?
Well, I have a fundamental thesis that the advent of the gold and silver ETFs, which came up in 2007 and 2008, stole some of the market share that the mining stocks traditionally held for decades prior to that. Because prior to 2007, 2008, if you wanted to invest in precious metals on paper, the mining stocks were the only alternative. The ETFs since 2008 have given you a pure alternative to mining stocks, where you have to worry about the deposit, the company, country risk, etc. But gold has made such a big move in the last 12 months. It's up about 40%, that it's finally giving the miners a lot of breathing room from cost per ounce production cost to sellability. And on top of that, we're having a whole fundamental shift towards gold as a safe haven asset that we've never seen before in these macro terms. And that is, I think, going to help to drive miners substantially higher, because a lot of the public really doesn't get it. But the people like you and I who are participating in the market, we understand that there's leverage here to be had. And if gold goes up another $500 from here, which is entirely possible, that'll be that much more profit they'll make, which is why they have leverage to start with, because their costs are pretty fixed. Energy is one of the main components that fluctuates the most for them, energy costs, because those big machines take a lot of energy. But otherwise, miners are finally in a really catbird seat to gain a lot of profit potential the way the gold market's going right now. And I do think their market share will increase, especially when the FOMO crowd starts to really follow, which I don't think has quite happened yet.
No, I don't think it's happened yet. You could just go about anywhere outside of our sector and people are not talking about either gold or the gold miners. Not yet. All right, so let's talk about a little bit more of this this gold push macro, on a larger scale. Dana, gold demand has been diverging between the West and the rest of the world. In North America and Western Europe, retail demand for gold bars, coins, it's declined for actually 3 consecutive years. Meanwhile, retail markets in Asia, South America, and Africa, they've seen rising demand in the same period. This trend continued into the first quarter of this year, contributing to the widest demand gap on record between the West and the rest of the world. Last quarter, demand in the Asia Pacific region rose 3%, led by China, which was like 12%, and 30% in South Korea, Singapore, Malaysia, Indonesia. Most recently, sales of U.S. Mint's American Eagle gold coins, it's a proxy for retail demand, it dropped more than 70% year over year in May. Now, you may be seeing some of that in your business over there. Asian demand is for gold, it's stronger than ever, clearly. Will the West, in your opinion, catch up at some point, and what do you expect this catalyst to be?
Well, what we have right now is a market in the U.S. where there's not a lot of fear. We had a whiff of that in April with the tariff turmoil that was created. But the U.S. economy has been doing fairly well. Inflation's been coming down. Our debt has continued to rise. But there's not a driving factor here in the U.S. to make the U.S. public become fearful of stocks or bonds like we were when COVID hit. And we sold a lot of gold between 2020 and 2023 because of COVID and the economic closures. But there's a lot of more complacency now here in the U.S. in particular. So physical demand in the U.S. is low. In fact, we're seeing an abnormally large amount of sellers harnessing the higher price for whatever reason, whether they want to move money into stocks, whether they want to compensate for inflation's bite, which is probably more like 20% than 3 or 4% over the last couple of years in total. But since we weaponized the dollar and there's been a push to get outside of the dollar, there is no viable BRICS currency. There won't be, in my opinion, for years. But what has become material to the global South is gold. And gold is becoming, again, the world's reserve currency. And it's actually starting to take a step in front of the dollar and our treasuries as safe haven status, especially after all the tariff turmoil in April. I looked at gold ETF inflows into China in April, and they were quadruple the previous 3 highs. When we announced our reciprocal tariffs on Liberation Day, April 2nd, Trump had tariffs on everybody that shocked everybody, right? On April 9th, because of the bond market blowout, that's why he pulled the reciprocal tariffs. But he didn't pull them on China. In fact, our tariff rate from China went from 54% to 104% to 154% in 3 days. Now, these are not tariffs. These are exclusionary tariffs. If you ask anyone in the US, what does 154% tariff mean? We all say the same thing. Well, things from China are going to cost more. But if you're a Chinese market maker or a producer of something, your biggest customer has just told you, we don't want to take your product. That's really what it meant. And the Chinese in particular, they have 3 ways to invest: stocks, housing, both of which have underperformed completely since COVID, and gold. And they bought gold in record amounts because of that knee-jerk tariff shock and drove the price from 3,000 to 3,500 in 3 weeks, which is one of the most astounding runs I've ever seen in my 45-year career. And it signaled that gold is really the safe haven asset. Now, we don't get it in the US because we've never had our currency fail or we've never had war on our shores. But if you live in one of those countries that has, gold makes sense to you. Right now, we may be approaching the point where we do have our currency fail the way our debt's going. I'm sure we'll talk more about that. But there are some really big fundamental shifts, and gold is getting a lot of the tailwind because of them right now. And most of it's because of the uncertainty of our trade policies. And we're pushing, our friends and our foes off because of President Trump's negotiating tactics, which are bullying. Right now, what happened? Yeah,
I was going to say to your point about what's happening over there in the Asian circle and how they've purchased so much gold in the last couple of months, driving the price up from 3,000 to 3,500. There are so many buyers now compared to the last go around in the early 2000s. China was still very poor back then. India was very poor. The South Korea, et cetera. That whole area has really risen in economic stature over the last 20 years. And there are so many more buyers, willing buyers, to protect the whatever wealth they've accumulated over the last 20 years than there was the last go round.
Exactly. And we're seeing market price dominance shift from the COMEX towards the Shanghai Exchange or even the London Exchange because of this. And in fact, most of that run that occurred, I measured it in a timestamp to see when the price really moved, and it moved during the Asian market sessions. Now, on top of that, China imported a record amount of platinum in April as well, 1,000 ounces, which put a squeeze in the physical market. Lease rates are up to about 13% on platinum right now, and that helped drive the platinum price from 900 in early April to over 1,400 just a couple weeks ago, which is a 45% gain in 10 weeks. And they took in more platinum in a month than I believe the NYMEX had in both registered and available physical platinum, which was 350,000 ounces.
That's amazing.
They're driving things much more than most people realize, and they're going to continue to do so as time passes, I believe.
Yeah, I agree. All right, so let's move over to silver. Considering that the United States, they're the world's largest producer of weapons and military equipment, they consume significantly more silver than they produce, which has helped lead to the 5-year global supply deficit that we're in. And given also the ramping up of all the global war preparations that we've been seeing, since 2022, do you expect this intensifying battle for the limited silver supply to inevitably lead to a massive price spike at some point, unless a substantial amount of new supply is brought online?
Well, I don't think we're going to bring a substantial amount of new supply online, number one. Number two, silver is mostly a byproduct of mining of other metals. Mexico is the leading producer of silver. I think they supply about 70% of the world's silver, if I have my statistics right. But we are in a structural physical supply deficit, and that's going to continue. Looking at the gold to silver ratio, it's about 92-1 today. The highest it's been was 124-1 during COVID, when we had a really abnormal liquidity event and the silver price fell from 18 to 12 while gold held up a bit better. It lasted about 4 days. But recently, the gold to silver ratio spiked at 104 when gold hit 3,500 and silver was still under 32. So we are seeing the silver price starting to break out. It is in a technical breakout right now over $35 an ounce. but it's really got to clear 37 to give it room to run up to the next level, I think, which would be 44, 42 to $44 an ounce. Silver goes late in the gold run cycle. And I think, if you measure gold's run as a ball game, we're probably in the 5th or 6th inning, and silver tends to run hot in the 8th or 9th inning. So I do think silver could play catch up substantially and get well over the previous 2 all-time highs of around $50 an ounce into the $70, $75 an ounce. Triple digit silver is a little hard for me to envision right now. I don't like to look too far over the horizon because things change, but I certainly think we could see the gold to silver ratio get back to a 25-year average of 62 to 1, which would put silver in the, above $50 in the $60 range, the way gold is right now at 3,400, 3,350.
Yeah. Yeah, and we've seen FOMO do really amazing things in various asset classes through the years, whether that be real estate or tech stocks or you name it. So it's quite possible that if FOMO decides to show its face in the precious metals market at some point, that could drive silver that high. So okay, so Dana, do you take the worldview that because of the monetary debt and currency issues that we see globally, combined with the electrification, AI, and robotics revolutions that are just going crazy, that the metals, including the monetary ones, will be needed more than ever before, yet there's not been the corresponding CapEx cycle that's commensurate with the need, and therefore supply and price will be radically impacted at some point in the near future?
Well, that's a loaded question. That may be a little above my pay grade. What I see is, the value of financial assets like stocks are so high right now, and there's so much money out there, and the precious metals pool is so small relative to that I think that we're seeing a refinancialization of the monetary metals now: gold, silver, platinum, and palladium. And part of what we've seen just the last 2 months is a rotation out of gold, but staying in the precious metals sector into platinum, palladium, and silver, where probably a little bit better opportunity has been. I think we'll continue to see money come in to our sector as time passes, and perhaps in a big wave if we get a real weak U.S. economy or trouble in the U.S. economy. Now, with AI and robotics, that has the potential to undermine U.S. employment, right? Because a lot of the high-tech jobs are going to be done by robots. And AI is already decimating some industries, like in Austin, Texas, where our business is. We have programmers who are on the street now because AI has replaced them. Now, our city went after tech people for 20 years, and we built this beautiful little city into a big one back on the back of tech. And now there's a lot of programmers that are looking for jobs. So I think that this revolution, has potential to make the human experience, much more rewarding. So we can do more with less, but I think there's a price to be paid for that. And it's so early in the cycle, it's hard to say.
Yeah.
So I don't know if I got your question properly answered or not.
That's okay. That's okay. I do think labor displacement is a critical discussion point. There are people who have conflicting views. They talk about how tech, the onset of new technology has never, taken out jobs in a net negative way. It's always created more than it's taken over. And then I've heard people say that this time is different because of the speed and the breadth of which AI is going to, take the jobs, and that by the time folks even retrain into something else, those jobs will be, moved over, that AI could do those better. So I've heard them, all the different viewpoints, but AI and robotics does require, all of the metals and minerals in order for it to go to
Right.
that degree.
Right.
And the data center build outs and just the whole, the electricity grid build out, everything requires the metals in order for that to occur. So even if we have AI and robotics taking over so much, that would mean that we would have data center expansion, electricity grid expansion, and all the mining needs in order to make those robots work and the AI to work properly. And therefore, the demand for the metals is going to, in either scenario, is going to skyrocket, but has the appropriate CapEx spending, been put in place in order for the requisite metals that are going to be needed to be able to come out of the ground? I think that's the question, but we could leave that for another day.
Yeah, I don't think that is the case. I don't think the mining companies have spent enough to harness the needs that may occur if the need for metal, goes up 20%, 50%, or 100%. I mean, they've been surviving the last 5 years on tighter margins because of higher energy costs. And now they finally have some profit margin, but it's new. They haven't had a chance to reinvest that. And these are long-term cycles when you talk about CapEx with mining companies, right?
Exactly. So
I think they are underinvested, and the deposits are getting harder and harder to reach.
They are. So yeah, I think so. I don't want to put words in your mouth, but it sounds to me like it's your perspective that there has not been enough spending in order to drive the needed supply here over the next 3-5 years for when they're going to need it, when this AI robotics, revolutions really start exploding out.
Not at this point in time. Not
Yeah.
yet.
Yeah. All right, let's go back to the consumer for a moment. The Wall Street Journal reports that consumer credit scores now reflect the pay later loans, and that's a problem with rising delinquencies. Also, rising student loan, mortgage, and credit card delinquencies, they're impacting scores negatively too, leading to a fairly substantial aggregate decline in credit scores, which is going to ultimately affect access to credit. Despite this, though, the economy seems relatively, unaffected. Recent data does show a modest 0.1% drop in personal spending in May. It is the third decline in 4 years, but it's not, it's not taking down the economy. Inflation adjusted spending, it's dropped a little bit more, negative 0.3%. But anyway, household finances seem to be under increasing pressure. What are your thoughts on the consumer, their impact upcoming on the economy, and do you see any implications here?
Oh, I see some big implications. I do think the consumer is kind of at the end of the rope when it comes to what they can afford in the current marketplace. Interest rates coming down a bit is helping. Inflation coming down is helping, but I think the big bite has already been taken out. When you have people, Danielle DiMartino Booth, who I'm friends with, I interviewed her a month or two ago, and she said at that point in time that student loan defaults were about to be reflected in credit scores, which was going to take everybody down a notch that hadn't paid in years, because now they were going to be forced to repay, and if they hadn't, that's part of their credit. So the consumer, with what do we have, $1.33 trillion of credit card debt now? I mean, it's record high. Interest rates on credit cards are high. People are buying groceries with buy now, pay later. I mean, this is a serious problem. But because we have the top 10% of the wealth in our country spends about 30% in our economy, it's insulating that lower part of our economy's woes that they're feeling in their credit, their ability to spend. But we're starting to see some chinks in that armor now too, according to Danielle. So I do think the economy is going to continue to erode lower. And my biggest concern is employment, because once we start to get into a layoff cycle, which we really haven't had since COVID, because first of all, companies couldn't replace employees if they got rid of them, so they held them longer, right? But now that's loosening up. And if we go into a weaker economic cycle because the consumer is losing purchasing power, I don't buy what Jerome Powell says, that wages are up and the consumer's holding purchasing power. I don't get that. I really don't.
Well, I think to your point, spending is down 0.1%, and it was down inflation adjusted 0.3%. So I think what you're saying is true.
But it is weakening modestly, but it's trending lower too, right? And we're 70% consumer economy. But when layoffs really start in earnest, which is the way that corporations can cut their costs the fastest, that tends to create a self-fulfilling cycle or a vicious cycle. And Danielle's concern was that once that starts, it's hard to reverse that trend, and it tends to magnify pretty quickly. So she was under the her analysis indicated that we could go from 4.2% unemployment rate to as high as 4.9% by September, which right now looks a little aggressive. But Anna Wong, who's a financial analyst with Bloomberg, highly respected, she thinks we could get to 4.8% by December. So those two projections for higher unemployment are not that far off. And if that happens, the economy will weaken substantially.
Well, and this could be why President Trump is calling for interest rate cuts. So he's calling them to be cut to as low as 1%. And he's stating that he's going to replace Fed Chair Powell with someone who's going to immediately cut rates. Meanwhile, we got stocks at all-time highs, real estate prices at all-time highs, U.S. debt is at all-time highs, crypto's at all-time highs, gold's at all-time highs. There's really never been a time in history where the Fed cut rates to 1% with the stock market and home prices at all-time highs. You know, Fed Chair Powell's term, it comes to an end in May of next year. What do you see happening to the markets, real estate, and the metals if rates truly get cut down to 1%?
Well, 1% is extremely low from where we are right now, but we have seen most other central banks around the world cutting rates where the U.S. is holding up higher.
Yeah,
you know, I think Powell is in the middle of another policy error by not moderately reducing rates to accommodate for what appears to be a weakening economy. I think his fear of a tariff driven inflation impulse is a bit overstated. But if we were to substantially cut, that has the potential to push inflation up higher. And we're seeing a divergence between what the bond yields are relative to the federal funds rate. Now, when the market went into turmoil in April and May, bond values fell, yields spiked, and the dollar fell. That usually doesn't happen when we have turmoil in the system because the U.S. is safe haven. But it's not a safe haven now. The dollar's down over 10% since the start of the year. And if we
moving to gold.
Yeah, and it's losing to gold, but foreign money is leaving the U.S. due to a lack of trust.
Yeah.
Right. And we have less money to fund our debt and our deficits. That means we're going to have to pay higher interest rates to roll those treasuries over. And I literally went on ChatGPT this morning to see how much debt we have to roll over in the next 2 years. It's $18 trillion. 18 trillion, which is half of our debt. And Treasury Secretary Bessent just said in a Bloomberg interview the other day, well, why would we roll it over into long-term rates when the rates are higher now, when we're going to get them lower? I mean, he was on Janet Yellen's butt for doing that, right, selling short-term rates between 2021 and 2023 instead of longer-term rates when the rates were lower. But guess what? The market wouldn't take the longer-term treasuries at those low rates. She could only sell the shorter-term treasuries.
Right.
And that's why we're in the bind we're in now. And the world is already starting to distrust us more, and that money is going home with the dollar going down. There's tailwinds in other economies and other markets because of the money leaving the U.S. and better opportunity elsewhere. If we lower our rates, how are we going to finance our debt if we can't attract foreign capital on top of our own capital? We won't be able to. That'll cause the Fed to print more, and that really creates the vicious cycle even more in earnest.
Yeah. Okay. So with everything that we've been talking about here, Dana, what is your current perspective on the future of the gold, silver, and platinum markets amid all the global economic shifts that are occurring?
Well, gold's had a record 12-month rolling period. It's up 45%. When we get a big move like this, it can channel for a while within a trading range. And right now that trading range is about 3150 to 3450. I see it moving sideways for a bit longer until something happens, a shoe drops somewhere. We're seeing conflict easing a bit right now. We haven't heard much about the Ukraine war. and Russia is continuing to advance, and they're taking more and more territory. You're not seeing any of that in the Western press, but that's going to get settled to Russia's advantage, I believe. I thought the Israeli-Iranian conflict would have more of an impact on the gold price, but it hasn't, and that's good, and hopefully that is over now, right? So that'll take a little steam out of gold, but there's such a huge potential debt problem, and it's not just us, it's global. The only major country that doesn't have debt to GDP over 100% is China, and they're at about 85% with 16 trillion, on the books debt. We've got 36 trillion. Japan's at 250% of GDP. So I think that the problems that we're going to face are going to drive the metal substantially higher. I think gold could get over to 4,000 this year. I think we're looking at $6,000 to $7,000 gold in the long run pretty easily. Silver, I think, could be $60 to $70 an ounce. Platinum and palladium are, more commodity metals than monetary metals, but they're substantially undervalued at about, $1,350 for platinum today. That should be, closer to 2,000 relative to gold, and palladium should be the same, I believe.
Yeah, and to your point about the debt problem, we're running $2 to $3 trillion annual deficits, and I think the Senate just passed the bill. Of course, it's got to get through the House and then get signed, but you're talking, estimates saying 4 to 5 trillion in new debt, which is going to grow the deficits even further. Doge came and went like a, highly hyped snowstorm that, turned out to be a flurry and a dud. It's just really, it looks like full steam ahead for deficit spending.
Yeah. The Senate did pass the bill today. I believe it was 4.5 trillion in tax cuts with 1.2 trillion in savings. And according to the global debt clock, Doge has saved us about 500 billion, but it's not going to get that much farther. Doge is. No. So you're right about being kind of a flurry when we thought, an avalanche was coming.
Right.
But, our deficits are just going to continue to widen. If we go into an economic slowdown, that makes things even worse. Lower tax receipts, more government spending. Yeah. I mean, the recipe right now is not good. And that all bodes well for precious metals.
Exactly. Okay. That was great. That was a great ending summary to that question. All right. Well, this has been an incredible discussion, and I just want to welcome everyone who's tuning into this fantastic interview with Dana Samuelson, president of American Gold Exchange. Before we wrap up here with our final set of questions for Dana, I just want to direct everyone who's interested in the metals and mining sector to dive into our Substack at metalsandminers.substack.com. Join our quickly growing community and receive a free report. It's titled, "If You Don't Own Gold, You Know Neither History Nor Economics." That's a famous quote by investing legend Ray Dalio, and that's the name of the report. Consider upgrading for access to premium content. But even without that, there's plenty of free content daily. So visit metalsandminers.substack.com to join us and explore. Now, I'm positive that you've been enjoying the conversation that Dana and I have been having. Please let him know by hitting the like and subscribe button and leave a comment below the video. All right, Dana, we're going to go into a lightning round. I mentioned this to you, prior to turning on the cameras here. I'm going to ask you to rank a few assets, give them a score of 1 to 100, with 100 being an extreme buy and 1 being an extreme sell. Give one or two sentences as to why you take the position. And if you don't follow the asset, it's totally okay. Just say you don't follow. We'll move on.
Okay.
All right. And we'll use a 6 to 12 month time horizon from now. Okay. All right. Okay. So on a scale of 1 to 100 right now, is gold a buy or a sell, and why?
I would rate it an 80. I do think the chances for gold to go substantially higher are very good. You might be a little early at this point in time, but I don't think this market has much downside in it. So I do like it very much for that reason.
Okay. Gold miners, 1 to 100, and why?
90 to 95. I think that they have the potential to play catch up seriously in the current market. And if there's a wave of FOMO money that comes in, that could turbocharge them. So I would rate them higher than physical gold right now.
Okay. Physical silver.
Silver, again, would be a 90 to a 95. I think it's undervalued relative to gold by 20 to 30%. And I do think we could get a move within the next 6 to 12 months that could bring the gold to silver ratio down from about 90 to 1 down to about 70 to 1. I think it's very possible.
Okay, silver miners.
I don't know enough about silver miners to speak intelligently.
Okay. I've got two energy assets, uranium and oil. Do you follow either?
Yes, I think uranium is the future for energy in the world, nuclear energy. And I do think uranium is a buy. I'd call it an 85.
Okay. What about oil? Do you follow oil?
Oil, call it a 60. I think it's going to go higher. I think the world is going to continue to use oil substantially. Potential for disruptions in the oil supply are pretty good. I don't see a lot of downside unless we get a real global recession going on. I do like oil fundamentally, and I'm going to stay long oil myself.
Okay. NASDAQ.
25. I think we're headed for a weaker U.S. economy, and I would call that a sell, and potentially a big sell in the next 6 months.
Okay. S&P 500.
Same thing, but I'd label that a little bit more solid, probably a 35 or a 40, but still I would take profits at these numbers today.
Okay. Short-term treasuries, we'll say under 2 years.
I do think the federal funds rate is going to come down, so you could get a little bump in the value of the treasuries. Call them 55.
Okay. And what about long-term treasuries?
Oh, that's a really tough question. I think rates are too high right now that they will go down, but I don't think the market is going to agree. I think the market will push rates higher, especially for long-term U.S. debt due to a lack of trust. Call those a 20.
Okay. On a scale of 1 to 10, each representing a percentage, where do you see inflation ending 2025?
1 to 10 in terms of percentage. Oh, okay. Let's see. I think inflation will end up eroding further, probably to about 2%.
Okay. Now, 1 to 10 probability, 10 the highest. Are we headed into a recession before the end of 2025?
9, yes.
Okay. And 1 to 10 probability that the markets are headed up for a melt up over the next 6 to 12 months.
1, very low.
1. Okay. And lastly, the recommended portfolio allocation used to be 60-40, 60% stocks, 40% bonds. That seems to be changing radically. What is your recommended precious metals and precious metals related equities portfolio allocation right now? And which bucket are you pulling from in terms of that allocation?
Well, I would pull out of stocks. I would pull out of bonds. I like everything that's tangible in the current environment, whether that's precious metals. I do like oil. I like uranium. I like copper. I also like real estate quite a lot, especially rental properties where you can get a cash flow out of. But I think the opportunity to buy will get better before this year is over, with both lower prices to buy and lower rates because of an economic slowdown. So I'd keep my powder dry there for now, but look for a big opportunity to spend towards the very end of the year.
Okay, so you're completely out of the stock market, traditional assets as well as the bond market, and you're making up 100% of your portfolio allocation to the items, the asset classes you just mentioned.
Right. I think that the world is going to continue to be fundamentally inflationary, but we'll see how it goes.
Yeah. Okay. All right. It's been a wonderful conversation. Dana, would you please share a key takeaway that you want viewers to keep in mind about today's economic, market, and monetary situation, whatever you think about, and then let everybody know where they can learn more about your work and how they can connect with you?
Well, fundamentally, gold is stepping forward as the global first choice for safe haven, which it hasn't done for decades. And this is a big shift. And the most fundamental reason is it's immediately liquid and it has no counterparty risk. And that is, I think, crucial in the current environment where half of the world doesn't want to trust the US or trade in the dollar. And I think the market share is just going to continue to increase. So I think it's fundamentally important that you own, gold and silver, platinum and palladium, and other tangible assets like uranium or oil or copper. That's why I believe in those metals.
Yeah,
Uh,
makes sense to me.
yeah. So we're a physical precious metals dealer. If we can help anybody with, fabricated modern bullion products, we also do a lot in vintage coins. Our company's American Gold Exchange, located in Austin, Texas. Our website is www.amergold.com. Email is info@amergold.com. And phone number 800-613-9323. We'll help anybody we can. No trade is too large or too small, and we answer every question and try and help people in a consultative nature make the right decision for themselves.
Wonderful. I really appreciate all that. I'm going to put all that information up on the screen as well as in the description area so everybody can click through and get over to you. If you haven't been following Dana, you really need to. If you haven't ever had a conversation with Dana, you need to take advantage. He's a wealth of information and he's ready to share about the precious metals with you. Dana, thank you for coming on to Metals and Miners and for being so generous with your time, analysis, and ideas. It's always wonderful to spend the time with you. You're going to be down in Boca next week for the Rule Symposium. I look forward to speaking to you there and seeing you there and spending some time on that dinner cruise that we're going to be going on. You're also going to be a keynote speaker, I believe.
Yes. I'll be able to get on the main stage for about 20 minutes and give my latest update on what's driving the gold price higher and why, some of which we covered here, but I'll do it a bit more in depth there. And it'll be great to see you in person again, Gary. And thank you so much for all the great work that you're doing, spreading intelligent information that's actionable for people. I really appreciate your increasing people's knowledge of the precious metals sectors and the miners. It's crucial at this point in time. So thank you for all the good work you're doing.
Thank you so much. I appreciate that. I'm going to put the Rule Symposium information up there too, and a link in the description area. So if anybody wants to actually be a virtual, get a virtual ticket or something, you absolutely can. In addition to Dana, there's just an incredible cast of keynote speakers that are going to be there. The wealth of information. If you're interested in the metals and miners mining sector, you really need to tune in to the Rule Symposium. So Dana, look forward to having you back on sometime soon. Thanks again for being here, and everybody else, thank you for watching. All right. Well, this has been an incredible discussion, and I just want to welcome everyone who's tuning into this fantastic interview with Dana Samuelson, president of American Gold Exchange. Before we wrap up here with our final set of questions for Dana, I just want to direct everyone who's interested in the metals and mining sector to dive into our Substack at metalsandminers.substack.com. Join our quickly growing community and receive a free report. It's titled, "If You Don't Own Gold, You Know Neither History Nor Economics." That's a famous quote by investing legend Ray Dalio, and that's the name of the report.